Hi fam, welcome to Electron FX. Before we go into the topic for today, which is the concept of stop hunts, liquidity traps, and how to avoid them, I would like you to go to the description page and click on our Telegram group. There we post analysis, we post trade setups, and information that are relevant to trading. And also you will get the link of our videos as they drop. So just take a moment, go to the description page and click on our Telegram page so that you can have access to all of this, right? So that is by the way. Now, the concept of stop hunts, liquidity traps, and how to avoid them. Now, these two things are interrelated. When we talk about stop hunts or liquidity traps, we are trying to say the same thing. The idea of your stop hunt being hit and then markets going your intended direction. I know most of us have at one point or the other experienced this, that the market was um, buying, and then we try to join the buy, and then you get stopped out, and then the market now reversed. That kind of stuff. The market is kind of bullish, right? And then your thoughts that you could buy this market, right? Then the market comes down to this point. That kind of stuff. Market comes down. Market comes down to this point, and then form some kind of double bottom. So you see this, right? So you saw this rejection, right? So hoping that, okay. So at this point, you are seeing some kind of induction to buy. So you saw this buy move once, you saw this rejection again, and then look at what price did. Price now did this, took you out, and then rallied up. So you're now wondering, why did the market do this? Why didn't just buy? Like you saw this, made a new high, you saw this, and then you're wondering, why did the market just have to just do this? Use 1 week or just maybe even a little week you out and still close above here, and then rally up, right? So that is the idea of what we're talking about today. Why do these things happen? Why do you see the market do this kind of stuff, right? Right. So that is a topic for today. The idea of stop hunt, liquidity traps, and how to avoid it. Now, a stop hunt is simply the market intentionally moving in the direction of where stop losses should be before going the other way, right? So when the market did this and did this, what they did is that they induced people to buy, right? Because people who are retail traders, they will see this and say, okay, the market rejected from here, we saw another rejection here, then they intentionally make price to go down, hit your stop loss, because this is where obviously you'll be placing your stop loss below these rejections. And then you see the market do this, and then you see one rejection for the week, right? Sometimes you may see the week may be so like this. Let's make this maybe blue. Also, let's make this blue. So this is a bullish candle, and then you see the market do something like this. See one very long wick. Have you seen this happen before? You see this very long wick. You see this very long wick. And you're wondering, what just happened? What just happened? So you're wondering, why did this happen, right? You see this just happen at this point here, right? See the market just wick you out, and then have a very sharp rejection, something like this. The market just do that, and you're wondering, what just happened? What happened? It is stop hunt, because as long as this market has not been able to close below this point, it's still a bullish market. Remember break of structure, that the break of structure is valid when the market closes below the previous structural point. As long as this candle did not close below this higher low, it's still a bullish market. So all this move was just to capture liquidity or stop loss as you may call it before rallying up. So that is the idea of stop hunt, for your stops to be hit and then the market moves. Now, why does this happen? Why do the market makers have to do this? Remember that whenever you click a buy trade, all right, it means that someone somewhere in the world is selling. That is the idea. So anytime I click on a buy, it means that there is someone in the world which has a sell idea or believes that the market is going to sell. So once I click a buy, my order and the person's order are kind of filled. That means my buy order fills his sell order and his sell order fills my buy order, right? So that is the idea. So whenever you take a trade, or you make a profit, that means someone somewhere lost that trade. That means if you buy this market and you close this market in profit, that means somewhere sold this and lost the trade. Remember that trading is worldwide. There are a lot of people trading the market, trillions of dollars. So you can't tell me that out of everybody in the world, there's no one willing to take a sell trade. Yeah. So some people will believe that this market is going to keep selling, and then they will take a sell, and then you that trade with the trend will buy, and that kind of stuff. So that is the first thing you should know about stop hunt. And the second thing is that we have what we call the institutions in trading. The institutions are the bank and the hedge funds. And now remember that when you click a buy trade, someone somewhere has to click a sell. So when these banks want to click their buy trade here, right, they need an equivalent amount of sellers for their order to be filled. That means if they want to buy the market here, let's say with 1,000 lots, right? They need about 1,000 lot of sellers for their order to be filled. Let me come again. These banks and hedge funds, when they want to buy a market, maybe at a support zone or at a place where people are hoping to buy, right? They need equivalent amounts of sellers to their orders. That means if they buy with maybe 1,000 lots, they need 1,000 lot of sellers before their order can be filled. If not, if they click buy, it's not going to activate, right? They need an equivalent. So now what they do is that, remember that whenever you close your trade, maybe you buy a trade and you close it, automatically you have sold it. I don't know if you have noticed it. When you click a buy and you close your position, you will see sell, and then they give you a profit or your loss. So what they do this here is to force people to sell, because once your stop loss gets hit, you have automatically sold this market. So they intentionally sell the market here because the market moves based on volume. So since they have the money to move the market to their direction, imagine this: you are buying with maybe 5 lots here, and someone came here and sold the 5,000 lots. There's no way the market is going to go in your favor because the market moves based on orders. So what they do that they intentionally sell the market with a bigger lot size. They may force you to sell this bullish market by hitting your stop loss. And now, since you have sold the market to them, they can now simply buy and the order will be filled. Maybe they can put their buy limit somewhere down here and then intentionally sell this market so that people that are trying to buy will be forced to sell when their stop loss hits. And when you have sold to them, their order cannot be filled. They cannot simply buy from you at a lower price and then take the market up. And how you will notice is that you always see a very strong move, because anytime the institutions are involved in the market, you always see a very sharp, strong move, which will create a lot of imbalance, and you see a lot of momentum, proving that someone with a lot of money was in this market. And sometimes this thing happens so fast. It can take it just 30 minutes. You see one funny second and then they push on. Just know that the institutions took the market. I hope you understand now why stop loss happened. And there you cannot avoid stop hunts completely, because you are not there with the institutions to know when they're going to click or buy. But what I'll be teaching you is how to identify those traps, or how to know when you should stay out of the market. Right now, this is it. Since you have known the concept of stop hunts and all of that, the liquidity trap is also the same concept in a way. Liquidity traps are those structures which induce buyers or induce sellers, right? They are those structures that induce buy. Like this was an example of a liquidity trap. The market did this, induced you to buy, and then took out a stop loss and then rallied up. That's an example of a liquidity trap. Let's look another example of a liquidity trap. Now, see this example here. The market was in a bullish market. You see the market making series of higher highs, higher lows, higher highs, higher lows, higher highs. Look what the market now did here. The market now did something like this. Came here, did something like this. I see what it's doing. Market now came down a bit, and then look what happened. Market fired up. So this is an example of a liquidity trap. At this point here, look at what the market was doing. It was inducing people to sell this market. Remember, this is a bullish market. You should even be selling the market, but based on you're seeing the market rejecting at that point, so you feel like this market may buy, and then look at what happened. The market intentionally sold. The market now sold. So that is the idea of liquidity trap. I hope you understood this. There are those structures that induce people to buy a market, and then the stop loss are taken out. So at this point, instead of this market has formed a higher low, so market will simply go up and form a higher high. It's not hard to do this rejections here. People will see this and say, okay, all right. And then they will see this sharp rejection again. So, all right. So when the market comes to that point again, they will feel, okay, this market has rejected 1, 2, 3. So it's something like, okay, that's given something like a triple top. This will always be the last touch, and then the market just tapped that place and broke through. So that is it. That's a liquidity trap, right? That is a liquidity trap. I just want to make a last example of a liquidity trap, and then we move on how to avoid liquidity traps. How to avoid liquidity trap and stop loss and all of that. Okay. There are several ways to do this. Very simple ways to do this. Several simple ways to do this. Avoid this liquidity trap. And the best thing to do is just to stay out of the market. Just stay out. That is the best solution to this. Just stay out. Just stay out. So now this is the last example of a liquidity trap. Now the market was buying. This one is the most wicked one I have seen the market do. So now the market does something like this. To do something like this, do something like this, do something like this, do something like this. Form some kind of range at this point here, right? Right, this is a bullish market. So the market comes and do something like this, a kind of range with equal tops and equal bottoms. So you see this, the market do this, make rejections from the upside and rejections on the downside. Now you will, okay, this market has done this market may sell from here. So people will be lured to sell from here. So people will be lured to buy from this point here, right? And then look what the markets will now intentionally do. Since the market has seen that people have bought and they have sold, so what they would intentionally do is you will see the market do something like this. The market will take out the stop loss at the downside, and the next thing you see the market do this. You're wondering what just happened. This happens. I don't know if you have noticed it. So now this was your support we're looking to, the result of you are looking to sell from. And this was also a support we're looking to buy from. Now wondering what just happened. The market just did this, took out the simple stop loss, the buyer stop loss, and then went for the seller stop loss and still took them out and rallied up. Remember, this market was a bullish market. This was a higher low. So since this low could not form a high, this is not a higher low. So this is our valid higher low because it was the last low that formed a new high. So this market is still bullish, but this was all what we call internal liquidity or liquidity trap to lure people to sell and to lure people to buy. So how do you avoid this? How do you avoid all these traps? Now, to avoid these traps, before I talk about that, I want to make sure that we do a mentorship program, and what we do is I will teach you forex from the beginning up to any area you have difficulties. I will teach you how to be profitable, right? We teach you a lot of things. Our classes are still ongoing, and we're doing a bonus just for this week, right? Between now to Friday, we'll be accepting just $50 for just 3 people, right? The class is usually $60, a lifetime mentorship on how to trade and all of that. So you can register today or tomorrow or Friday. You mustn't make the full payments. You can pay $25 today and pay $25 maybe before the end of Friday, right? Today is the 28th of September, or let's say 29th, sorry. So between now to Friday, which is the 1st of October or thereabouts, I don't know, just calculate 3 days from today. Today is Wednesday, so by Friday Friday is the last day, right? So you just click on the description page. You will see the link to register for the mentorship program. Just click and register. We enroll you. Remember that you're taking only 3 people for $50, only 3 people, and then the price will go back to what it is, right? Now, how to avoid this? How to avoid this? Now, to avoid this stop loss and liquidity trap, the first thing to do is always to trade in direction of the trend. As long as this market is bullish, you should be looking for only buy opportunities. And now, which of the time frame is best to check your structure? Always check your structure with the 4 hour and above. That means don't always check your structure with 1 hour, 30 minutes, 15 minutes, because 15 minutes will always give you all those traps. You always see traps or structures which will not be obeyed. You see the 15 minutes being bullish for now. Next thing you see a break of structure. It's not bearish. It's just taking out everybody. So to avoid this, number one way is to stick to higher time frame structure, such as a 4 hour and above. Don't come below 4 hour. If you're looking for a bullish setup, look for it on the 4 hour. If you're looking for a bearish setup, look for it on the 4 hour, daily or weekly or monthly. Just avoid anything below 4 hour. Or if you must come down, you can use 1 hour, but 1 hour is not too reliable. So I would suggest you use 4 hour to check your structure, right? So 4 hours should be your reference structure, or daily to check your reference structure. And then you can use your 1 hour for entries, or your 1 hour to check where you would likely enter. So 1 hour should just be for entries, 30 minutes, all of that should just be for entries. All right, it should not be for checking your structure. So that's the first way to avoid liquidity traps. Stick to higher time frame structure, right? And the second way is to always trade in direction of the trend. That means as long as this market is bullish, you should not be looking to sell at this point here. This should ignore this, because this market is a bullish setup. So the only trap that may catch you is this one that went down before going up. So you may not be able to avoid this one, but at least you avoided one of the traps, which is the reverse direction bias, right? So this market is a bullish market. I don't see any reason why you should be looking to sell this when the structure has not broken to the downside. So as long as the market remains bullish, you should be looking to only buys, only buys, only buys. So with that, you avoid this kind of scenario where you try to sell here and then. So that is it. Avoid that kind of market. Don't buy a selling market. Don't sell a buying market. That's in the second or third way to avoid stop hunts and liquidity traps. And the next way is to avoid double bottoms and double tops. All right. Always avoid markets like that. Avoid market and making double tops and double bottoms. You're seeing the market testing a level severally. Don't treat those kinds of markets. Avoid them. So avoid double tops, avoid double bottoms. And another way to avoid liquidity trap, avoid those kind of setups. Avoid double bottoms and double bottoms. Avoid them. Trade structurally, higher high, higher low. So always avoid those kind of markets. Markets like this, it comes with a lot of liquidity traps. So the market will be doing this to bounce to here, to bounce to here. Sometimes the market will just naturally weak some people out and then continue the range to continue again, weak these people out, continue the range, continue the range, and then finally decides to break and take everybody out again. So look at what happened. Look at what happened. Look at what happened. Look at this. So you see this, take out buyers, continue the range, took out sellers, continue the range, and then finally took out sellers completely. So avoid this kind of markets. Avoid markets that are ranging in between one zone and the other, because most often the market is going to take out stop loss or force you to, those kind of stuffs. Avoid double tops, avoid double bottoms. Trade structurally, higher high, higher low, lower high, lower low, right? Another thing is that avoid the levels that have been tested severally, right? Avoid those levels that have been tested severally. I know as in adage say that if your support has to be tested 2 or 3 times, strong support, strong resistance, all those kind of myths, right? Because maybe the market tapped there, bought for 5 days, it came again, tapped here, bought again for 5 days, came again, tapped here, bought again for 5 days, and then you are expecting the market to still come down there and buy. Now it's going to do this, it's going to take you out. It's going to take out eventually. So avoid levels that have been tested so many times. Like this level that has been tested once, twice, avoid it. Don't try to buy there again, right? Don't try to buy. And now the final way to stop or avoid liquidity traps is always to wait for a confirmation candle before taking your trades. That means when the market is approaching the support or resistance, always wait for the candle to give you an engulfing candle, a pin bar, a doji, all those reversal candle patterns before taking your trade. Don't just buy because the market has come here, or sell because the market has gone to resistance. Always wait for that reversal pattern Wait for the market to give you that reversal pattern indicating that it's going to go up. Wait for the market to reject, give you those things, those confluences, those engulfing candle, divergence, all those stuff that indicate that it's going to go up before taking your trade. So don't just buy because market is going to support or sell because market is going to resistance, right? So I think I've mentioned several things that will help you to avoid stop points and liquidity traps. Avoid those levels that have been tested severally. Use bigger time frame structure. Avoid levels that have been avoid trading against the trend. Look for buys in the buying market and sell in the selling market. And these are the ways which you can combine and limit the number of times in which you get clapped by the liquidity traps and the stop hunts. So that is it for now. I will still post more videos. Please, if you have not subscribed to the channel, please click on the subscribe button and like the page so you can get more videos as they come up. Please, our mentorship program is still ongoing, and I think we'll be stopping our mentorship program very soon. Very soon, we'll be stopping it because of the idea of what we are doing with them. We have to take it from the beginning to the end and all of that. So from now to Friday is $50, and if you're interested, just hit the description page and sign up. So that will be all for now. Cheers and God bless you.